If you're new to real estate, one of the fastest ways to lose money is assuming a bad deal will look obviously bad. It usually doesn't. It looks exciting. It looks urgent. It looks legitimate. And if the person presenting it is confident enough, it can feel like the exact opportunity you're supposed to act on before someone else does. That's how people get trapped. Not because they're careless, not because they're lazy, but because bad deals are packaged to feel persuasive long before they're exposed as expensive. By the time most beginners realize the deal is weak, the money's already committed, the timeline's already slipping, and the certainty they borrowed from the pitch is gone. Once you understand how this works, you start seeing the pattern everywhere. Let's break it down. The first move is to use selective numbers. This is probably the most common move and the hardest to catch, because the math isn't always fake, it's framed. They show you the deal through the best case lens, the highest possible rent, the lowest repair estimate that still sounds believable, the fastest realistic exit, the strongest comp in the area. None of those numbers are necessarily invented, but they're chosen. And when you stack the best version of every variable on top of each other, what you get isn't a realistic projection, it's a highlight reel. Real deals have friction, repairs run over, timelines slip, vacancies show up at the worst possible moment. Holding costs keep accumulating while your exit sits there doing nothing. None of that makes it into the pitch, so the numbers sound real, they just don't reflect what actually tends to happen. That's the first trap. Once the spreadsheet feels good, the brain wants to believe that the rest of the story is true. You stop asking what's missing and start assuming it probably works. The second move is to anchor the numbers. The pitch opens with one massive upside figure. Maybe it's a $200,000 equity spread. Maybe it's a projected assignment fee. Maybe it's a cash flow number that sounds life-changing. And once that number lands first, your brain starts organizing the entire deal around it. You stop asking, is this actually a good deal? And you start asking, how do I get access to that? The shift is expensive. The moment you're emotionally chasing the upside, you stop evaluating the downside honestly. You start rationalizing instead of analyzing. Now the anchor number is doing more than informing you. It's controlling you, and this happens all the time. A beginner hears the big upside, sees the confidence behind it, and starts trying to make the rest of the deal fit that first number. That's not underwriting, that's hope with a calculator. The anchor number isn't just a data point, it's a framing device. And once it lands, everything after it feels smaller, safer, and easier to accept than it actually is. The third move is to use broad language. Bad deals often survive by hiding inside vague language. You hear the same phrases over and over: cosmetic work, value add, motivated seller, transitional area, strong rental demand. Some of those phrases can be accurate, but some of them are just verbal makeup. They sound positive without telling you anything specific. Cosmetic work can mean a full renovation. Value add can mean the property is underperforming for a reason nobody wants to explain. A motivated seller can still mean completely unrealistic terms. Strong rental demand might not mean strong rental demand at your number. This is one of the clearest differences between beginners and experienced investors. Beginners respond to attractive language. Experienced investors pressure test it immediately. They ask, how much exactly? Which costs? What repairs? What permits? What timeline? What happens if rent comes in 10% lower? And what happens if the exit takes 3 months longer? That specificity is what separates evaluation from enthusiasm. The less specific the pitch, the more careful you should be. Vague language gives weak deals room to breathe. And if you don't force clarity, the pitch will keep thinking for you. The fourth move is borrowed certainty. This one's subtle, but it might be the most expensive move of all. Sometimes the deal isn't that strong, but the presenter is. They're calm, they're polished, they've got stories, they've got answers for every objection, and they know how to make hesitation feel like inexperience. Like the downer feeling is just a sign that you're not ready yet. Without realizing it, you stop leaning on the deal and start leaning on them. He's done this before. She clearly knows what she's talking about. Maybe I just need to trust the process. Maybe my hesitation is just fear. That's borrowed certainty. What makes it dangerous is that a polished presenter can make a weak opportunity feel much stronger than it is if you're unconsciously using their conviction as your due diligence. You're no longer evaluating the deal. You're evaluating whether the presenter feels trustworthy enough to stop evaluating the deal. That's a completely different process. And it's exactly how people get pulled into bad opportunities with good marketing. The presenter's confidence doesn't transfer to the deal. The deal still has to stand on its own. The fifth move is identity pressure. This is where the pitch stops being about the property and starts being about you. A lot of gurus don't just sell the deal. They sell what saying yes means about your future. The deal becomes your first real move, your breakthrough, proof that you're serious. Evidence that you're finally thinking like an investor instead of an employee. And now saying no doesn't just feel like passing on a deal. It feels like rejecting momentum, rejecting the version of yourself you say you want to become. That's powerful pressure. Once identity gets attached to an opportunity, skepticism starts to feel like a personal failing. People override their own caution not because the numbers convince them, but because backing out feels like backing down. That's why bad deals can feel so personal. And that's why people defend them even when the numbers start to wobble. You're not defending a property anymore. You're defending what saying yes meant about them. Real investors don't do that. They don't need a deal to validate their identity. They let the asset be the asset. They let the numbers qualify or disqualify the opportunity on their own. The sixth move is collapsing the timeline. This is where pitches make deals, well, not just profitable, but easy. Find it, lock it up, fix it, rent it, refinance it, cash flow it. Clean, linear, simple. Except real deals aren't simple. Real deals get weird. Title issues come up, contractors go silent, appraisals miss, sellers change their minds, buyers disappear, cities take longer than anyone planned, numbers shift. None of that automatically means the deal was bad from the start. It just means the deal was real. But when someone teaches a deal with all the resistance edited out, the opportunity looks dramatically easier than it actually is. And when risk is invisible, the deal will always look better than it is. People don't just buy the upside, they buy the smoothness. They buy the illusion that the whole thing moves in a straight line if they just take action. That's rarely how it goes. So here's a quick reality check. Picture the moment. You're watching someone walk through the deal. The numbers look good. The spread sounds huge. The presenter's confident. The room's nodding along. Everything moving fast. And then it happens. You stop asking whether the assumptions are solid. You start wondering whether you're about to miss out. That's the handoff. That's the exact moment a deal stops being math and starts becoming emotion. And once that switch flips, bad deals get very hard to see clearly. So, here's what real investors actually do. If those are the moves, what does someone with a real risk do differently? First, they disqualify early. They're not trying to rescue a weak deal emotionally. They're trying to kill a bad deal fast so they don't waste time, energy, or capital. Second, they ask friction questions. Not just where's the upside, but where does this break? What assumptions are carrying too much weight? What happens if the timeline slips? What happens if the numbers come in lower? What happens if the exit's slower than the pitch implies? Third, they separate the deal from the presenter. Confidence isn't a substitute for underwriting. Experience isn't a reason to stop asking questions. The deal has to hold up on its own. And fourth, they don't let urgency replace verification. If the deal disappears because you took time to check it properly, that's usually not a missed opportunity. It's a filter working exactly as it should. You don't get paid for being excited first. You get paid for being right. Bad deals rarely show up looking bad. They show up looking exciting, with momentum, with credibility, with urgency, with math that appears to work until you slow it down enough to see what's actually there. That's the whole game. The language matters, the framing matters, the confidence of the presenter matters, the speed of the pitch matters. All is designed to move you forward before you had enough time to think clearly. That's your job, not to get swept up, to slow the deal down until it either holds up or it doesn't. Because in this business, confidence is cheap, clarity is expensive. And the investors who last the longest usually aren't the ones who believe the fastest. They're the ones who verify the longest. If you want the real frameworks, the structures, the strategies that some our companies wrap in hype and high-tech packaging, the practical stuff without the markup, the vault is linked in the description below.